is the clock is ticking. It's why if you're a boomer sitting on big home equity or a buyer waiting for a break, the tax clock is getting loud. 2026 isn't far, and the rules may not be as friendly as they are today. I'm going to keep this simple. The taxes move markets. When capital gains and related thresholds shift, inventory, pricing power, negotiation leverage. Here's the trap I keep seeing boomers fall into. You bought decades ago. Your place is worth way more now. The federal home sale exclusion. $250,000 if single. $500,000 if married. It hasn't budged since 1997. In high appreciation markets, that exclusion can get swallowed fast, and every dollar past it can face capital gains tax. Add state taxes, hello California, and maybe the 3.8% net investment income tax if your income's high, and it's no wonder people feel locked in. Now layer in 2026. The tax cuts from a few years back are scheduled to sunset. That likely means higher ordinary income brackets and lower thresholds for long-term capital gains rates to kick in. Translation: the same sale could push you into higher brackets more easily. Estate tax exemptions are set to shrink too, which matters if you're planning to hold and pass assets later. So what happens between now and then? Pressure. Sellers don't want to miss a potentially better tax window. Buyers are watching rates and waiting for inventory. That tension usually creates windows, short pulses of listing activity, sharper pricing on homes that need updates, and more willingness to negotiate repairs and credits. If you own and you're considering a move, you have a few lanes to explore with your CPA and your 1031 specialist. Time a sale to maximize the current exclusion and your income year. Consider a 1031 exchange for investment property to defer gains. Explore installment sales to spread income. Look at opportunity zone investments under current rules. Refresh your estate plan before exemptions sunset. If you're buying, here's what 2026 could mean for you. More listings from strategic sellers, especially dated homes and long-held properties. Negotiation leverage on condition. Negotiation leverage on closing costs. Negotiation leverage on rate buy-downs when days on market stretch. Local divergence, premium, turnkey homes stay tight. Mid-tier and fixer stock gets more flexible. My playbook, sellers. Get a net sheet that models taxes now versus post-2025. Don't guess, run the numbers. Then tune your prep, light renovations that move the needle, realistic pricing, and a launch timeline that hits the most buyers. Buyers, line up pre-approval, rate float strategies, and inspection pros. Target homes with long ownership histories. That's where deal mechanics live. And be ready to write clean offers with smart contingencies. Speed and certainty still win. The big idea, the market isn't waiting for 2026. People are positioning now. If taxes get less favorable later, the best window may be the next 6 to 12 months. Use the clock. Don't get used by it. If you want a custom plan, look at timing, tax-aware pricing, or a buyer strategy that hunts for equity. Reach out. I'll help you read the clock and move before it strikes. The clock is ticking. Call me.